Welcome back.
Yes.
Week 2 in action.
Week 2 in action, face-to-face podcast this week. We love the face-to-face ones.
Yeah,
all about that. Very crazy week. We're just talking about it.
Tell me.
Now, no, you tell me. I want you to tell me about your trip to Melbourne.
So I went, as everyone knows, we had the SMSF limited recourse borrowing arrangements leasing on Sunday night. So I had a few people that wanted to purchase property in Melbourne. So I thought, fuck it, let's go down, let's just have a look and see what's going on. Flew down there, did 17 open homes. It was a monster fucking day, I'll tell you that much. In saying that, out of all the homes, there's only a couple that were, I think, they were good to buy. And on top of that, which was the biggest thing for me, was out of the whole 17 open homes, I only saw one other couple.
I was going to ask you that. So, like, how many people attended these open homes?
I didn't see anyone.
I saw someone, I saw a real estate agent and was having a chat to him about him having, I think it was about 50 open homes, like across, and it was him and other agents, right? 15 open homes, and they had about 17 in total, and that was New South Wales. And so, like, it's quiet out there, very quiet. And I mean, is that an opportunity? What do you think? Is that an opportunity, or is it, is it quiet for a reason? What do you reckon?
I think it's quiet for a reason. It's just starting, to be honest. I think in the data last week, we saw auction clearance rates tick up. I think that was expected because of the SMSF thing.
SMSFs,
So I think now that's come and gone. It's passed. I think this is the first actual week where we're going to see what the market looks like.
Everyone's like, exactly.
Because there's no urgency now. There's no urgency. Last week we had the SMSF urgency.
The closure.
This week there is no urgency. So now, of course, if you're a first-time buyer or an investor, you're going to wait. Right? I would wait. And I think that's what a lot of people are doing, because they're like, well, the new rules have come through, negative gearing, capital gains tax, causing big issues with the property market, we know. But is it going to get cheaper?
And I think this is where people are going to make some big mistakes. So I see it as an opportunity. And I think people who have the old, the Warren Buffett mentality, buy when people are scared type of thing, I don't think that's a bad idea, but I can see them that not every property is going to be good. I think now more than ever, property selection is going to be the key. Like, I think if you asked me 5 years ago, it'd be like, just buy. Like, you'll buy somewhere in Australia, you do all right. You'll do all right, you know what I mean? Whereas now it's like, no, hold it. We don't know what the market's going to do, but there are probably some indicators that we can still pick a good property from. Asset selection is going to be really important over the next, I think, 2 years. Like, I think it's going to be a while. I don't think it's going to be a quick fix.
I don't think so either. And like, of all the properties I saw on the weekend, there's only a handful I would even buy myself. To be honest, because there were a lot of properties that needed a lot of work. And like, just the small things that you pick up with experience in terms of, you can see if it's a leaking bathroom, there's mold, you can see it leaking to the bedroom next door, hidden behind the bed, just little things like that, that if you're not in the game and you haven't been buying properties for a long time, you wouldn't know. And this is where you rely on experts, and sometimes those experts just want you to buy a property, and experts, and then that's where you get caught out. But I think definitely going forward, I think asset selection is critical. You need to buy the right type of asset. That's a good one. And that's not 11.
Now we did it on a previous podcast where we brought up the best places to invest on ChatGPT, and we asked AI, and there's a lot of service businesses at the moment who the conversation is in the next sort of 10 to 20 years, are going to be redundant because of AI. Do you think that there's too much of a reliance on AI when it comes to property? Because I had a client and he did his property selection via AI. What's your thoughts on that?
It's definitely the new way. I think with all of these tools, it's one of those things to actually help the process. So you can find data on population growth, you can find data on average rental income and all the rest of it. But what it comes down to is buying the right property in the right area. That usually comes to the major hubs. The major metro hubs, followed by government infrastructure. If you sort of follow those basic, simple rules, you should be okay.
So you're saying that if you plug that into like an AI server, Claude or ChatGPT or something like this, and you look at the data yourself, your average person could get a result that's quite good.
Look, yes, definitely the data is out there. If you know where to look and how to use that data and interpret it, I think we can help. But I also know a lot of people that are trying to find the next hotspot, you know, and they're looking and say, I had one person reach out to me looking in regional New South Wales, saying this suburb's the next one to pop. And it's like, when you're looking at stuff like that, it's more like a gamble, right? Because you haven't got any data to sort of look back on, like it's very scarce. So how can you make decisions on what's going to come up next? Of course, you know, you could be lucky, you could hit the jackpot, you know, and buy like, you know, we're in New South Wales, Box Hill 15 years ago, and now you made a mozza. But in saying that, you could also not make the right decision. You know?
I think you're right with that. Is that I was watching a YouTube video, a little bit off topic, but I'll connect it back. But I was watching a YouTube video of a guy trying to make Flappy Bird.
Okay.
You remember the Flappy Bird, the game on your mobile?
Okay.
So he was trying to make that, and he was using Claude or ChatGPT to help with the coding. And he was seeing he's a coder, he's a developer himself, and he was seeing if ChatGPT could do all of the work for him. And at the end of it, he said, yes, it could do it eventually, but he had to analyze it himself to make sure that it was doing the right thing, and he had to give it the right prompts. And I think when it comes to services in the next sort of 10 to 20 years, I have an idea that, you know, your average Joe on the street that's plugging in property data or asking questions to ChatGPT about property, they're going to get an answer, but are they going to have the skill to be able to interpret that to make a good property decision? And maybe experts will still be required to be able to not only prompt the AI correctly, but also to be able to take that data and then analyze it correctly.
Oh, look, I agree. Like in terms of, like we can get the data, but then buying a property is a whole process. You know, then are you going to then negotiate with the real estate agent? Are you going to get a better price paying someone else to do it on your behalf, or if you're going to do it yourself? If you're not a good negotiator, AI can only take you so far. So I think professionals definitely have a part in the process. They can probably make the process easier, so then you can focus on working with them to get, you know, a list of better properties or more properties to look at, rather than just spending all that time to find one or two or three. You can maybe find 10 at that time. I think that's where the value comes.
Absolutely. Either way, I don't think AI is at that point yet.
It's coming,
but it's coming. I agree. Now, back to mortgages and property and what's happening there. We had a rate hold.
Yes.
Did we predict it?
Look, you predicted it.
Did you think it was going to be a rise? I forgot what you said.
So I said that I think they should raise.
You did say that, yes.
I think they should raise. If they do it now, it's going to save the pain later in November before Christmas. But they decided to hold, and I think they're already talking about raising later in the year. I
know,
But it's like, wouldn't you want to rate rise now, get it over and done with, so then when we get to Christmas, everybody's all happy-chappy, and they just start spending.
As opposed to like a November rate rise or something like that.
Exactly.
So I think what it does though, when you hold it, I think everyone sort of holds their breath and goes, oh, please don't be a rise, you know, especially, you know, mortgage holders, please don't be a rise. They say it's hold and they celebrate. After yesterday's decision, part of me sort of went back to our conversation and I thought, okay, does that just indicate that there will be a rise soon? You know what I mean? And maybe we're celebrating too early, that there will be a rise maybe in the next couple of decisions, you know?
Well, Michele Bullock specifically come out and said, and she goes, just before everyone starts asking, there was discussions of a rate rise, rate hold, no discussions of a rate cut. So that sends a clear message to the market that they're not cutting this year, at least, right? Already Westpac, I think, came out, ANZ, saying we don't expect anything to happen this year, this calendar year, more likely than not next year. If anything were to happen.
Absolutely. We've seen a few lenders actually rise rates out of cycle too, and that's usually an indication that, you know, they're obviously cost of lending. It's usually if it's out of cycle, it's usually a lender issue. But it does indicate that the cost of lending as well as rates, you know, don't look like they're going to drop anytime soon.
So have you seen in the last week what's happening in mortgages, in the mortgage market?
Well, again, we've had sort of this false economy thanks to the SMSF mortgages. So, you know, there was a big rush, a lot of applications, banks, some lenders were just completely smashed. The SLA's just gone, you know, through the roof. But it will be interesting to see now, you know, and it's literally only the start of this week. So there hasn't been enough data, but I am seeing, and I was talking to you about this, more interest now. Okay. And in just general investing, a lot more owner-occupied than investor, in fairness, but I am seeing a lot more interest now in getting loans. And I find that interesting, that more owner-occupiers, because it's sort of like, okay, well, maybe these tax changes are incentivizing first-time buyers to sort of get into the market for a property, you know, for themselves. There has been a slowdown for investors for sure.
Yeah, well, I saw CBA release their results this morning, and the profit number was like 10.9 billion or something ridiculous like that.
Most profitable banks in the world.
Of course. But they were saying that from May onwards, I think their loan applications for properties were down like 20% or so. You know, that was just the start.
Yep.
That's just the start.
Yep.
You know, end of May, I think it was the budget, to June is only a very small window for data collection.
Yep.
So let's see what happens over the next few months.
Yeah. And it's hard to, because I talk about my experience in my business and what we do and our clients, and I know that that's not shared by every mortgage broker. So, you know, for instance, we've had a little bit more interest this week and the start of this month compared to last month. But I wouldn't necessarily say that that's shared across the industry. I think the industry as a whole is very quiet at the moment.
Okay.
And so, you know, take that as you will. What decisions do we make on that? What do you think? Like, what decisions are we making knowing that the market's quiet? Do we stay quiet as well, or do we use it as an opportunity?
Well, just going back to last week, I could see that the agents weren't dropping the prices, you know, and then I think the market as well doesn't understand what's just happened.
Yeah.
You know? So, for example, investors now, there is no negative gearing on established properties. So I did a bit of while I was at the airport, back of the envelope calculations. To buy property A, it was going to cost an extra $1,600 to $1,800 a month out of pocket.
Yeah.
Now negative gearing is not there. You know, after you do a tax effect, you know, you get your tax refund because of that loss. You're probably going to get back about 30-40% of that. Now all of a sudden that's gone. So now that's gone. It impacts mortgages, mortgage borrowing. Now serviceability drops. However, the vendor is still wanting the price pre-budget changes.
Yep.
And I think that's what's happening with the market.
And I don't think enough agents are having that conversation. I before I got into lending, working at the bank and all that type of things, I worked in sales. And I know in sales, if you get into a rhythm, you get into a rhythm of, you got your script, or you got your, you know what to say to handle an objection, all those types of things, and you know how to close a deal, and you get quite good at it. Now if someone comes in and changes the product, or they say, hey, now something's changed, you have to relearn your sales process, because you're like, I can't do the same objection and handle things, I can't use the same script. And I think real estate agents, it's the good ones are adapting. I think a lot of the ones in the industry are struggling to sort of understand where the market is, and it is a buyer's market. Like, if you've got a buyer interested in your property, you need to change your process to secure that buyer and have real conversations with your vendor to say, hey, look, maybe the price isn't where you think it is, and maybe we need to consider a different pricing, or maybe let's secure this buyer on good terms. I think that's where it is.
It's definitely a tough conversation to have with vendors. I think everybody thinks that prices continually go up, but we've seen over the last few weeks, you can see property valuations already dropped.
Yep.
They're dropping, and they've already dropped. And this morning on the news, I know the media sort of make a bit of fear as well. ANZ calling a 15% price drop, which, look, it could happen. It could happen because these changes are unprecedented. They're big changes.
Yeah, huge changes.
And look, Albanese is there at the moment. I think this is going to really rattle his support as well, because whether you're left, right, green, One Nation, it doesn't matter. If the property value of your house is dropping, they call it the negative wealth effect. If all of a sudden your property is worth less, you're probably going to spend less just in the general economy.
Of course, yeah.
And that has a negative impact on the economy. And that's why they did raise rates.
I wonder how many people have had conversations about budgets with their partners and their families and stuff, in the last few months, because especially if you've got a mortgage, especially if you've got an investment property, or you're thinking about, you've got a particular wealth strategy, and that wealth strategy, if it included property especially, or any type of asset buying, with the capital gains changes as well, they have to reassess that,
Yes.
Have to massively reassess that. And we spoke about new properties as well. Like, even new properties isn't a silver bullet. Everyone goes, well, there's still, there's still negative gearing on new properties. Well, but there's a second-hand market. Who's buying your, new property after you hold it for X amount of time? Well, if they don't change the laws and there's no negative gearing, that means the buyer of your property now will have to be able to service a loan without negative gearing, and will have all those same issues. So I think there's a lot of people having conversations about how we're going to generate wealth in this economy and after these rules. What would you say is because obviously we can talk about markets like their shares, and I think people do naturally, markets up, markets down, property will increase. And I think, you can maybe hold me to this, quote me on this if you'd like. But property, in 30 years' time, property's going to be worth more than it is today, unless something's, really dramatic happens. So what do you think are the wealth levers for families in Australia at the moment? What's left?
Look, I think the majority of people do like property. You touch, see, feel it.
Yeah.
I think when people start going towards shares and managed investments, all that type of stuff, because they can't see it, they can't feel it, they're just numbers on the screen. They get really apprehensive. And when it comes to leveraging debt, property is probably the most leveraged debt there is, right? Because you can put 10% or 20% down, and the bank will give you the other 80%. Bang! If it goes up, you make money because you've now leveraged your 20% and you times it by 5. Or if it goes against you, which it has for a lot of people, in particular first-time buyers that bought since towards the end of last year, it compounds the other way.
That 20%'s now a $250,000 loss on a $20,000 investment type of thing.
Exactly.
So
I think,
absolutely.
So this is where it comes down to the quality of the asset, the location of the asset. I always tell people, don't go over leverage yourself. Just because everyone else is buying a property doesn't mean you have to buy a property. It may not be the right time for you to buy one. So it all becomes part of your wealth strategy.
I made a video about borrowing capacity and budget, and because I think it's people, you hear your borrowing capacity. I'll give you an example. You got your budget and you come and you go, okay, I know I want to buy about $500,000, and people go to their mortgage broker and say, okay, I want to buy $500,000, but I also want to know my borrowing capacity. It's the most common question. What can I get? And you go, okay, well, look, if we do the application with the budget you've given me and everything, it looks like you probably get about $850,000, and then the cogs start saying, "Oh, okay, interesting. I can get $800,000. I can push my leverage up a little bit. I can get a little bit more. I didn't know that I could completely leverage from my equity, and so now I've got 110% leveraged property."
Yes.
And so that sounds great, and it's very hard to switch that off. And so no. I came in here with a budget of $500,000. I'm going to stick to $500,000 because I know that that's what my budget is and that's what my plan is. And I made a video about it because I think you're right. I think over the last 10 years that over leveraging property has been a huge issue in Australia, where you've got spruikers, you can use equity, you can pull out equity and then go and invest in property. You've got 110%. If that drops 10%,
you're gone.
Yeah, you've got a huge loan against an asset that's nowhere near that, and you're going to have to wait for that to recover. And look, and that's not to say, leveraging equity to buy an investment property is a bad idea. No, that's not it at all. And then there's debt recycling. It's just so long as it's a managed plan and you're well informed about it, I think that's how you can protect yourself.
Well, the growth from COVID, 2020 to now, has been unprecedented, right?
Huge.
Because they printed money.
Huge.
So if you leveraged yourself into property back in 2020 or 2015 or whatever, you made money.
You're fine. Yeah. Even with a correction, you're good. Yeah, I know what you mean.
You definitely made money. But and I was saying this, you can watch podcast from last year, I was saying, hey, the government has to touch this, has to touch property. There is too much money in it.
Yep.
The budget's not balancing for the government. They're going to go for the easiest, lowest hanging fruit, and that's the property sector.
Yep.
And they did exactly that. And they just went with a blowtorch.
Yeah, massive, huge changes.
Huge changes. So, you just got to be, you need to understand what you're getting yourself into.
Yeah.
Because I also see people, they're like, they're not factoring maintenance costs. A hot water system goes, bang, that's $2,000.
What's my interest?
Yeah.
What's the interest that I have to pay the bank? And what's the rent? Oh, okay, that's it. That's the calculation everyone does. And you go, well, no, because I always get that all the time. I want my repayments to cover the interest. And you go, okay, we can get the repayments to cover the interest. Like that can be done. But is the repayments going to cover the agent fees? Yes. Is it going to cover the maintenance? Is it going to cover, any sort of contract costs for new tenants or anything like advertising costs for new tenants? Is it going to cover, everything, so rates or whatever that's associated with that property? And when you put all those factors in, is it going to cover any period of time where you might not have a tenant? There's lots of things to consider. It's not as simple as how much interest am I paying, and is the rates is my rent covering that? No, I agree. But I also agree when you were saying, I found it interesting you were saying where if you over leveraged 5 years ago, you're pretty much okay, even with the correction. So the question is not should I invest in property, it's should I, how am I investing in property? And I think that's probably a better question to have with your mortgage brokers, financial planners, accountants and stuff like that.
Of course.
Is how am I investing in the property? Not that investing's bad now. Am I investing in a way that I'm going to be protected if there is a correction, and I can ride out through the correction until it goes back to normal? And I think that's an interesting sort of conversation to have with them.
So in terms of lending, have you seen, because we were talking last week about commercial lending, resi lending, have you seen any more changes in that area?
No, look, the policy for the banks are changing all the time. So I don't think it's changing more than it was before. And when I say changing over time, not huge changes. Obviously, when the government introduces the tax, they have to react with a policy change, so previously we could add negative gearing into servicing.
Yep.
They have to, so that was a big change. But on a general note, other than sort of the big external influences, the banks themselves, their policies are staying relatively good. In fact, I'm probably seeing a move to more lenient lending.
Oh, wow.
For instance, like 1 year financials is being adopted by a lot more lenders than previously. Previously had 2 years and you averaged the 2 years or whatever. Now we're having lenders coming in and saying, actually just last year financial in isolation, and we'll use that for self-employed individuals. So we're seeing a lot more adopt that. We're seeing rent shading. You can shade rent. We're seeing some lenders change their policy when it comes to shading rent so that they're not doing that as much, which again improves your servicing. And I think that might be maybe because there is a drop in applications that lenders sort of say, well, what policy triggers can we pull without APRA giving us a hard time? and there's definitely a lot that they can still do, and I think it is getting more lenient, and maybe over the next 6 months we might even see some more lenient lending policy. It won't change the rate or anything else, but I think they're trying to combat rates.
I've seen cashbacks already. Like I saw on TV.
Yeah, cashbacks.
Well,
yeah.
Which is so you sort of try. I'm sure the government would have consulted the banking sector before they made these changes. So it's done on purpose to slow down the housing market.
Yeah.
And of course, the private lenders are going to, or the banks, the private lenders are going to start to try and push the rules a bit, just to try and stoke a bit more demand. I know Macquarie Bank are dropping their rates. As an example, they're trying to hit the retail market.
Trying to get,
So I think they're going to do it, but I think that's all very minimal stuff. I don't think it's going to really move the needle that much.
Yeah.
If you shave a 0.1% off or 0.2% off a mortgage rate, or give a $2,000 cash back, doesn't mean you're going to borrow an extra 100 Gs.
Yep. The interesting thing that banks do as well, and it gives them leverage in markets like this where they can change rates and stuff like that, is that a lot of major banks, at least, we have the carded rate or just the standard rate. So the standard rates for the banks, let's say you go to a Big Four bank, you never really see the standard rate. If you're on the standard rate, you need to have a harsh conversation with your broker or the banker. You know what I mean? Call me, yeah. But no one's on that standard rate, which is 8 point whatever %, right? no one's on that standard rate. So what the bank does is that they actually offer discounts on their standard rate. So all the rates you're seeing advertised and stuff are usually discounts on their standard rates, and or they get their sort of package discount or this type of discount. And so that allows some lenders to, discount and increase, and they've got that margin. They don't have to wait for the Reserve Bank of Australia to change for them to, they can actually just refuse to discount, as harshly, or they can discount more harshly to be more competitive. And so if everyone was on their standard rate, their margins would just be massive. And I think it's a clever idea because it means that they can play around with the interest rate a little bit, or play around with policy like we're talking about, or play around with a few things to try and incentivize more and more people to lend when the government's disincentivizing it.
So no advice to anyone, but would you go fixed or variable at the moment?
Oh, not would I? No advice. Yeah, no, that's right. I'm a massive fan of variable. So, and I've always said it like this: trying to game the system. Like everyone's got a story from COVID times where it's like, I fixed at 1.99% and it was the best decision I ever made. Mate, it was a gamble. I was looking into the camera. It was a gamble. No one knew.
Yeah, right? No one knew at that time.
No one knew at that time. In hindsight, it's fantastic. It was a great decision. But the reason I can unequivocally say this, like the reason that they chose the 1.99 was because fixed rates were lower than variable rates. So they wanted the lower rate, you know what I mean? So that's why they chose fixed. It wasn't some strategy. So I'm a big fan of variable. I'm a big fan of not gaming the system because it always ends in disappointment. You get a fixed rate, rates drop. You get a fixed rate, or you go variable rate, rates increase type of thing. And there's no point doing that. I look at the features of the loan. Like, what does a variable rate offer me? As opposed to a variable rate, it allows you extra repayments. It allows you an offset account. It allows you to pay your mortgage down faster without any break costs. If you've got a good amount of cash in there, you can put that in there. You can refinance to a lender without a break cost, if someone else comes out with a better interest rate. So there's a lot of things that the variable rate offer that the fixed rate don't offer. They'll charge a huge break cost if you change it. They don't let offset accounts, no redraw, with a few exceptions. Some lenders might, but I always think of the features, and a variable rate's going to give you a lot more freedom for your strategy, and making those extra payments on your mortgage is
it'll help, right?
Good idea, yeah.
It'll help, especially when you look at a 30-year term. Even if you just chuck an extra $100 a week, it just shaves down like 10 years of loan or whatever. It's a ridiculous number.
Yeah,
like it just shaves it off.
Yeah, absolutely.
Why wouldn't you do it?
It's like the compound interest, but the other way around. You know what I mean? Yeah. Now, I got a question from the accounting side. So, as you know, we work with a lot of self-employed individuals, right? And self-employed individuals have a mindset. It's usually an entrepreneurial mindset, right? They set up a business, they want to make a bit of money. And so with that entrepreneurial mindset, there's a lot of investing. So self-employed individuals do a lot of investing. At the moment, if there is someone who's self-employed that want to buy a property, what things do they need to do in their business to make sure they're paying themselves, appropriately to get to a position where they've got the borrowing capacity and the capacity to then invest in property?
So I always find with sole traders or people that are starting out, they always say to me, they don't want to pay tax, right? That's the general
No one wants to pay tax.
No one wants to pay tax, but unfortunately, you have to pay tax. And the banks will use this for serviceability. If you go to a bank and show your income's only 20 grand per year, no bank is going to touch you. No one's going to go give you $1 million because you're only earning 20 grand per year. So firstly is to put the processes in place where you get paid properly. Get paid via invoice, register yourself with an ABN, get paid through the bank into a bank account, and then of course use that money for business expenses. Do everything above board because you're going to need it when it comes to serviceability with the bank. Whether you run it through a sole trader, a company, or whatever structure you use, you have to pay yourself a decent salary. And I think what people realise as well, or don't realise, especially when they start, is all the hidden on costs of running a business. You earn $100,000 per year. You have to pay yourself, or you got to pay the government 25 grand average in tax. And where people get caught out is they won't pay the taxes to the government, and at the end of the year, there's a huge tax bill. So do things properly, pay the government every single month if you can. Just like if you were to go work with somebody as an employee, they would either weekly, fortnightly or monthly pay you, not the full amount, the net amount. And then start paying yourself the proper net amount remit the amount that you need to the government, and that way you don't have any dramas or surprises at the end of the year.
You might even be able to get something back if you've sort of overpaid.
Overpaid, but that's what the bank will look at.
Yeah.
The bank will look at, hey, this guy, look, he's got a business, he's doing 300 grand a year, he's paid himself 150. Cool. We're going to use the 150 to work out how much you can borrow.
Yeah.
If you earn 300, but there's nothing in a bank account and you can't show anything, how is the bank going to lend money to you?
Yep. That's good advice. That's good advice, because you're right. I think there's this idea of like, how can I hide all my income? And there's this culture of trying to just not pay any tax. And I think when it comes to lending, unfortunately, the bank wants documents.
Yeah.
They're not going to take your word for it. What document can we show that shows your income?
Yes.
Tax returns, you know what I mean? So, and there's alternative documentation like BAS, or you can get an accountant's letter, but an accountant's not going to write some magical number on there. They're going to base it off the information they have, you know what I mean? So it is really important to make sure as a business owner you're paying. So I think that's great advice.
And then the other thing that people like to do to save tax is they will find expenses to get deductions. And it's like, do you really need to buy a new MacBook every single year? No. But you're buying it to get the tax deduction. You get the tax deduction, you're lowering your profit number, which the bank are going to use to give money to you. So you need to be tight. You need to declare everything. You need to be tight with your expenses, so you can show the bank you're making that amount of money.
You never net zero on a tax deduction. The expenses never completely netted zero. So every tax deduction you have to pay something. So don't do it. Yeah, don't pay for something just for a tax deduction.
I tell this service to people all the time.
It's the same. To be honest, and not to come full circle, but it's the same thing with property. And previously, when negative gearing was in play, people would go, well, I need property for the negative gearing, and you sort of go, well, why not just get a property? Eventually it'll be positive gear, but like, why are you paying money just to get it back? And I understand wealth and stuff like that with property, so you are paying money for a greater wealth, especially if it's leveraged. But yeah, you have to understand why you're spending money on something. Same thing with vehicles. Vehicles in a business name, that's a classic conversation too. I get it because my vehicle's a tax deduction, but then they've got the fringe benefits tax, which I hate.
Yes, you have to pay.
You have to pay it.
And the amount of people that come to me and want to buy a better car because it's in the business, it's like, it's still costing you money. Just because you get a tax deduction does not mean you should be buying a car that was supposed to be 50 grand. Now you spec it up to make it 100 grand. It's like, yes, you get the deduction if you use it for work purposes and all the rest of it, but you don't need it.
Now, there is a lending trap, and you probably know what it is. So there's a lending trap where if you want to buy a car in your personal name, it's regulated under the National Credit Code. You have to do all the checks and balances as if you were applying for a mortgage. Like, it is a big process. Income, assets, expenses, that type of thing. If you want to buy a car under your company, if you got good credit, your ABN's been active for a year or something, you're GST registered, how much do you want? $150,000 we can give you. You know what I mean? And I think business owners will go, well, okay, well, I'll get a vehicle. I can get a nice, I can get like a nice Tesla, like a top end premium vehicle, and I can get it so easy because I don't even have to provide any documents, even though I'm not paying myself. My business might not be actually operating, very slim profit. I'll get this huge car and then I'll drive my kids to school in it. And then all of a sudden when they do that, they get slapped with fringe benefits tax. They're overpaying for a vehicle because no one needs a Tesla if you're a plumber. You know what I mean? Like, so there's all these sort of bad decisions that people make, and I think it's because lending has created a way that it goes, you can either go the hard way or you go the easy way, and everyone's going, we'll go the easzy way, but they don't understand the cost associated with it.
Well, then it impacts you when you buy a house, or property, because if you've got a 150 grand loan, they're going to be like, well, how are you going to service this and the house?
Yeah, that's right.
So,
that's right. And most lenders will not all of them, but a lot of lenders will dig into your business financials. Like, don't think you can just sort of go, oh, here's my profit, and have a whole bunch of vehicles under the business under a loan, you know, because the bank will dig deep and go, okay, well, can your business now, your profit, afford the repayments on the loan, afford to pay you, and afford the new mortgage that you're getting? So that's a trap for self-employed. You know, there's some ways around it, but I think that's something that's definitely worth considering.
Perfect.
Cool.
All right, we'll leave it there for today.
Awesome.
And I'll catch you next week.
Sounds good. Thank you.